Okay, finance experts, now what we want to do is talk about pricing bonds. Remember, companies buy assets to generate cash flows to maximize shareholder wealth. They get money from creditors and shareholders. Now we want to price debt. We want to price bonds. So whether you're buying a bond as an investor or selling a bond as a corporation trying to raise money to buy assets to generate cash flows, we want to know how to price those bonds. Well, as we discussed before, the price of any financial assets, present value, expected future cash flows. For the bond, it's going to be interest payments, all discounted back, plus par value discounted back. The interest payments are going to be equal to the coupon rate times the par value. So the coupon payment or interest payment is the coupon rate. This is what the bond is paying times the par value. The interest payment, the coupon rate is fixed. The par is fixed, therefore the interest payment is fixed. So the top part, the numerator, is an annuity. Okay, this part, the interest payments, all discounted back as an annuity, and here is a lump sum. We're going to discount those cash flows back at RD, the return for creditors. As we discussed, bondholders expect or willing to take a lower return because they've taken less risk, because according to the income statement, they paid before shareholders are paid. So we discount back the cash flows, the first part's an annuity, and a lump sum. Okay? So let's do an example. Suppose Corporation X wants to raise money. Corporation X wants to raise money to buy assets to generate cash flows to maximize shareholder wealth. And Corporation X wants to borrow $1,000. Corporation X wants to borrow $1,000, so they're going to set the par at $1,000. Corporation X needs 3 years to pay back that $1,000 loan, and the going rate in the marketplace, RD, is 10%. Investments of like risk are given 10%. So Corporation X is going to set the coupon rate at 10%. So Corporation X wants to borrow $1,000. They want 3 years to pay back. The market wants a 10% return on investments of like risk. In order to get that loan, in order to get that money, I should say, and make that loan, the Corporation X says, okay, we'll give you 10% on your money. That's what happens with a mortgage. You want to go borrow money today to buy a house. The bank says we want 5% back on our money. You're going to give them 5%. That's the only way you're going to get the loan. That's the only way they're going to make the loan. You want to borrow money to buy your car. You go to the bank says we want 4% on a car loan. We're going to charge you 4%. If you want to get the loan, you have to give 4%. So Corporation X wants to borrow $1,000. It wants 3 years to pay back. The coupon rate is going to be set at 10% because the market wants 10%. Note that yield, this is also called as RD, return to creditors, return to debt holders, is also called a yield to maturity. So this is also referred to as a yield to maturity. Now, notice what happens with the corporate bond. Corporations, when they borrow money, they pay back only interest every year or every period. Bonds are usually paid semi-annually. We're not going to worry about semi-annual. We're going to do everything annually. We're more concerned with the concepts. So we would just make the adjustment from the first finance class. You know, we would make that adjustment from time value of money. We'd make that first adjustment going from annual to semi-annual. So we're going to assume all our bonds are going to pay annual. Okay, so interest is going to be compounded annually. But unlike an individual, when you borrow money to buy a car or a house, every period you pay principal and interest. So if you get a mortgage, a 6% mortgage rate to borrow money to buy a house, and they're going to charge you, you're going to pay back monthly, you're going to pay back 0.5% every month. 6% divided by 12 is a half. You pay every month, you pay back principal and interest. Corporations don't do it that way. Corporations borrow money, they'll borrow $1,000, and they're only going to pay interest every year, and they're going to pay principal at the end. So when you borrow money, if you got a 3-year car loan and for the fun of it you pay it annually, you would pay principal and interest at the end of the first year, principal and interest at the end of the second, principal and interest at the end of the third. Corporations pay only interest, okay? And the thought process is corporations buy assets to generate cash flows. You buying that asset to live in as a house. You buy that asset for transportation, your car. So we want you to pay back principal and interest each period. Corporations are buying the assets to generate cash flows. So we're expecting them to have enough to pay us back our initial investment. So Corporation X wants to borrow $1,000. They want 3 years to pay back. The market says we want 10% on our money. They're going to set the coupon rate at 10%. So let's go ahead and determine the value of that bond and the price of the bond. So what we're going to do is we're going to discount back the cash flows. So $100 the first, $100 the second, $100 the third, and then $1,000 at maturity. So the price of the corporate bond X, the value of the bond, is 100 discounted back at 1 plus 0.1 to the first, to the second, to the third, $100, and then $1,000 at maturity. So this first part is an annuity. The first part's an annuity. The second part is a lump sum. So here is an annuity, and here's a lump sum. And I'll show you how to do this in Excel. Here's the lump sum, and here's the annuity. So what we want to do is we want to discount back the cash flows and see what this bond is worth, and what it's worth is what we're willing to pay for it. So when I discount back 100 at 1.1 to the first, 100 divided by 1.1 to the second, 100 divided by 1.1 to the third, 1,000 divided by 1.1 to the third, we get a value of 1,000. So the corporation wants to borrow 1,000. It will get $1,000 from you today in exchange for giving you 100 the first year, 100 the second, 100 the third, and 1,000 back at maturity. Well, that makes sense. The price should be 1,000, because if you lend somebody $1,000 and you want 10% of your money, they should give you back 100 each year, and then they're going to give you back initial investment. So they give you back interest each year and then principal at the end. Well, what can cause bond prices to change? The question is, what causes bond prices to change? Well, let's come back to our equation. What can cause a bond price to change? Well, the interest payment is the coupon rate times par. Par is fixed. The coupon rate is fixed. The interest payment can't change. So if you get a house loan and you get a fixed rate mortgage and you get a 30-year fixed rate mortgage, you know exactly what you're paying every month in principal and interest. Taxes may change, property tax may change, insurance may change, but you know what you pay back in principal and interest. Well, the same thing for a corporation. The coupon rate is fixed, the par is fixed, the interest payment is fixed. The numerator is fixed. What can cause bond prices to change is the denominator, the return for an investment of like risk. This risk-return relationship can change. This risk-return relationship, this line can shift up, it can shift down, it can rotate and shift down. So it's a demand for money and a supply of money from economics, a supply and demand. So demand for money, supply of money. So what can cause bond prices to change is changes in interest rates. For whatever reason, market rates change, interest rates change. So what can cause bond prices to change? Well, a change in return in investments of like risk. So the question is, for whatever reason, what if RD, also called the yield to maturity, what if RD goes to 5%? For whatever reason, investors say, hey, for investments of like risk, we're willing to take a lower return. So for whatever reason, investors say for investments of like risk, this line is going to shift, say, down. And when this line shifts down, now investors, instead of wanting 10% return, want a 5% return. For whatever reason, look at what happens to gas prices. Gas prices are constantly changing. It's supply and demand. So interest rates change. It's supply and demand. So what happens to the price if interest rates go to 5%? Investments of like risk are given 5%. So let's assume for a minute that you just bought this bond. So you bought this bond from Corporation X that had a par of 1,000, maturity of 3 years, a coupon rate of 10%. You wanted 10%, you lent, you gave, you paid $1,000 for the bond. So you just bought this bond for 1,000. And the very next second, you decide you no longer want the bond for whatever reason. And the very next second, rates go to 5%. What's going to happen to the price of your bond? What's going to happen to the value of the bond? Well, let's go ahead and do the calculation. So the par stays at 1,000, maturity stays at 3 years, the coupon rate stays at 10% because that's fixed, and for whatever reason, the return that investors want on investments of like risk changes to 5%. So after Katrina, we saw what happened to the value of homes in Southeast Louisiana. We see what happens to oil prices. It's supply and demand. So we have these changes in interest rates for whatever reason. So rates have gone to 5%. So you just bought the bond. Assume that this is time period 0. You bought the bond for 1,000. You wanted 10%. The bond was given 10%. I'm going to move to my left, and this is going to be time. So time period 0, you paid 1,000. The very next second, you no longer want the bond for whatever reason. And you realize that rates have gone to 5%. What do you think you can sell your bond for? Well, now let's discount those cash flows back at 5%. So 1,000 discounted back at 5% to the first, 100. 100 is discounted back at 5% to the first. 100 is discounted back at 5% to the second. 100 at 5% to the third, and 1,000 at 5% to the third. You're going to get, I'm going to do each one. Again, this first part is an annuity. This first part's an annuity and a lump sum. I'll show you how to do it on Excel. But just to make sure that we can do it correctly, I'm going to discount each cash flow back separately and add them together. So $100 discounted back at 5%. That $100 that we will receive 1 year from now, today is worth $95.24. So you just bought this bond. I'm thinking about buying it from you. You want to sell it. You want to get the most for the bond. We all agree that the return on investment of like risk should be given 5%. So for that $100 a year from now, I am willing to pay you $95.24 for that bond, or for that cash flow. And $100 2 years from today, I'm willing to pay $90.70. And $100 3 years from today, I'm willing to pay $86.38. And 1,000 3 years from today, I'm willing to pay $863.84. So I'm going to discount 100 divided by 1.05 to the first, 100 divided by 1.05 to the second, 100 divided by 1.05 to the third, 1,000 divided by 1.05 to the third. I get my present values, add them together, and the price is going up to $1136.16. So you just bought this bond at time period 0. You bought the bond for 1,000 because you wanted 10% on your money. The bond was given 10%. The very next second, you no longer want 10%, or you no longer want the bond. You want to sell it. For whatever reason, the very next second, rates have gone from 10% to 5%. You realize that rates have gone from 10% to 5%. Now the value of your bond has gone up to $1136.16. So your bond has increased in value. Why did your bond increase in value? Well, you have a bond that's given 10% when the market now only wants 5%. So you can sell your bond at a premium because you have a bond giving the market more than what they want. You have a bond given 10% when the market now, a second later, only wants 5% on the investment. Okay? So the value of your real estate has just gone up. So a day before Katrina, you have a house for sale, and for the fun of it, you want $200,000. You have it listed at $200,000. You live in Hammond. Katrina comes through. Your house is not affected. 2 days later, the value of your house has gone up because now you have something that people are willing to pay a premium for because they've lost their house after Katrina. So we have an asset that has become more valuable because people have lost their homes, right? So We have a bond that's given 10%, this is fixed, when the market's only given 5%, and only wants 5%. So the price goes up. We have a bond given more than what the market wants. You may say, well, why doesn't the bond give 5%? It's fixed. It's just like if you drive a truck. You know, when gas prices, you may not remember this, but the gas prices at one time were almost $4 a gallon. And oil was trading at like $145 a barrel. Think what it is now. So when oil was $145 a barrel and gas was pretty close to $4 a gallon and above $4 a gallon in some parts of the country, people weren't interested in buying a big old SUV. So the demand for the SUVs fell, the value fell, the price fell, nothing changed about the vehicle. Now gas prices have fallen and people are willing to pay for that SUV and pay for something that doesn't get great gas mileage. So nothing changed about the vehicle. What's changing is the price for gasoline, the price for oil, which affects the price of the vehicle. Well, that's what's going on here. I have a bond that's given 10. For whatever reason, the market only wants 5. The bond's given more than what the market wants, so investors are willing to pay a premium above $1,000 for it. Okay? So you bought the bond for $1,000. The very next second, you no longer want it. The price goes up because you have a bond given more. We discount back the cash flows. Well, you can't change the cash flows. It's like the engine in your SUV. You can't change the engine size when gas prices change. Okay? Now let's assume that interest rates go up. For whatever reason, let's assume interest rates go up. So before we had this relationship, we were at 10%. Now in this case, let's assume interest rates, let's assume this line shifts up. And for whatever reason, investments of like risk are now given 15%. For whatever reason, the marketplace wants a return on investment of like risk of 15%. What's going to happen to the price of our bond? So what's going to happen if RD goes to 15%? Well, now where the cash flows are still fixed, now we discount back our cash flows at 15%. 100 divided by 1.15 to the first, 100 divided by 1.5 to the second, 100 divided by 1.5 to the third, and 1,000 divided by 1.5 to the third. 86, 96, 75, 62, 65, 75, 657, 52. Add these up, now the value of the bond is 885.84. So the value of the bond has fallen when interest rates go up. So let's go back to time period 0. Corporation X wants to raise money to buy assets to generate cash flows. They want to borrow 1,000. They want 3 years to pay you back. You want 10% on your money. They give you 10%. The very next second, rates shoot up to 15%. You no longer want the bond. You go to the marketplace and say, hey, I just bought this bond a second ago, and I paid 1,000. Can I get 1,000 from you? And people in the marketplace are going to say, no, I'm not going to give you 1,000. I want 15% on my money. Your bond's only given 10%. It's fixed. That 10% is fixed. The market says they want 15% on their money. The only way they're going to buy it from you is if you sell it to them at a discount. You're going to have to sell it to them at a discount in order for them to buy it. Now you may ask, well, how do they make up the difference? Well, remember, this bond is going to pay back 100, 100, 100, and 1,000. So you can think of it as when somebody buys this bond and wants 15% on their money, they actually going to be shorted in interest payments. They're going to make it up in terms of capital gains. They paid $885 and they're going to get $1,000 back. Okay? Just like before when you paid too much for it or paid a premium for it. Before when we paid $11.36, this bond was given 10 and the market only wants 5%. What's happening is every year they are getting too much, right? They're getting too much, And so they're gonna get $1,000 back at maturity when they paid $11.36 for it. So when they buy it at $11.36, they're gonna lose $136 because they were getting too much during the payback, during the 3 years. Okay? So you willing to pay, or you will pay less for this bond when you want 15% of your money. The bond is given 10%. You're going to buy it at a discount, pay less than $1,000. At maturity, you'll get $1,000. So the first thing I want you to realize is how to price a bond. Okay? Present value of expected future cash flows. The next thing that's important is realize the relationship. What causes bond prices to change? Changes in interest rates. What causes interest rates to change? Supply and demand, right? Supply for money, demand of money, okay? So demand for money, supply of money. So interest rates change. So when RD, or yield to maturity, goes up, the price goes down. Inversely related. When RD goes down, the price goes up. Inversely related. So the only thing that can change is the denominator. Numerator, denominator. So when the numerator, denominator. When the denominator goes up, the price goes down. Inversely related. When the denominator goes down, the price goes up. So it's inversely related. Okay? And that comes back to principles, right? So from time value of money, present value is future value divided by 1 plus r to the t. When r goes up, present value goes down. R goes down, present value goes up. Okay? So I want you to know how to price a bond, and I want you to know the relationship. Next, I'll talk about calculating yield to maturity, or RD.